Strategic acquisition, investment, and exit partners make up the biggest part of startup exit strategies. Here's why, coming up now. Hey everybody, welcome back to the channel. Thank you for tuning in, and if you're new here, please smash that like button and push that notification bell so YouTube lets you know whenever we're uploading new content. So let's go to today's topic: strategic acquisition, investment, and exit partners. Exit strategies, of course, are a must-have for every startup. If you want to know how to start a startup, I'm going to link up a video up here. But nonetheless, the most important part everybody's aiming for is to have an exit. The biggest exit you can get is an IPO, but not all of the companies, in reality, a minority of companies only make it to the IPO phase. Most of startups actually get bought by a strategic exit acquisition. But why is that the case, and what type of exits do we talk about here? Let's go into details. In general, we can distinguish 4 different types of strategic acquisition exits. One of them being scale, the other one being scope, the third one being roundup, and the fourth one being talent. So let's start with your strategic investment partners, because they most likely will become your strategic exit partner. Let's go for an example. Our company that I work in, we're a medtech company, and we're looking up companies that have a strategic gap in their portfolio. How do you do this? Well, you look at the offerings that those companies have, and we're talking about multi-billion-dollar companies, and you figure out whether or not your technology will fit in their current portfolio. You will have to do that thoroughly and invest a lot of time and effort to do that, but afterwards you can come up with a matrix that actually allows you to understand which companies have what type of gap and how you could fit in them. This actually makes then a very good and direct approach in you contacting them, offering your service or product to close the gap that they have. The more pain those companies will have on that gap, the more likely it is that they will come to you and might invest with you to help you grow and refine your technology so that it fits in their portfolio. At the end of this process, of course, you will have a strategic acquisition exit. So why do companies actually go through the effort and try to acquire a new company or technology? Most of the time, of course, it is because they were not able to get that technology by themselves, develop it by themselves, or they are, let's say, overtaken by the competitors and now trying to catch up with a different type of niche so that they are more attractive to customers again. Very often, companies looking for scaling. So if your product is actually in such a way that it helps to scale the acquisition partner's portfolio dramatically, then this is what they're going to do. They're going to kick out the management. They're going to very quickly take over your technology and implement it in their strategic setup. This, of course, is also clear then that you will have almost no saying afterwards. And once you sell your company, let's say general roles like management, financing, marketing, all these guys will be gone. And they might just have like the key know-how persons, and then they will keep them maybe for a short amount of time and afterwards let them go as well. Which is actually now important for you to know, so you have to be aware that if you're planning for an exit, you have to be aware what type of exit you're looking for, what type of minimum threshold is in it for you, and what are the circumstances that you would like to sell something. If an investment partner, an exit strategy partner, actually wants to buy a company for enlarging the scope of their business, this is a strategic move that companies make to enhance their portfolio or to enlarge it and to go into different areas they have not yet been in. Very often, this is an important move, and it actually is different from a lot of the other exit strategies because it allows the current startup company you're working in to stay more or less alive, just being financed by the acquisition partner, and develop the product or service further so that it fits the new owner's portfolio or strategy plan that they are looking for to fulfill in the future. The synergies that we're looking at here are more likely to be on a revenue synergy where you can leverage the existing sales force to upsell other products or your new products within that area. This is a very popular type of acquisition and is, to be honest, depending on the company portfolio size, of course, more likely or unlikely. Some companies do not accept this. They, just buy and do, let's say, a roundup. The round-out acquisition actually aims to have a similar scope, like the scope acquisition, but with a more target approach, where they think that only a few key employees are needed to take out of the company to then develop product and services in more depth that are strategically required by the acquisition partner. Now, this also implies that if your know-how and knowledge is not IP protected, it is very easy to just drag out people of your company, offer them double the salary that they already had, and then invest their time into developing the products again, or in a better way, for the new partner. Which leads us to the final section, which is the talent acquisition. Very often, companies like to have a specific group of people that they see in a startup or other small companies and like to acquire that talent. And they will go through a lot just to get them on board. Hence, again, if you are the CEO or the owner of a startup, it is important that you know what is to expect and what your strategic setup should be if things like this could be happening. Hence, you want to distribute the know-how of your company on as many people as possible so that everybody maybe has a fragment, but not everything, so which reduces the likelihood of a complete team going away. Secondly, you want to have IP protection like patents, trademarks, anything that sort that is not easily transferable by the persons, but requires a complete purchase of the company still. Of course, a variant of this talent acquisition is you buy the talent plus the IP, which is then integrated into the acquisition partner, and by that accelerating their own portfolio down the road, and also preventing other competitors, bigger competitors, to enter the market. At the end, it comes all down to startup owners and founders to think of what are their requirements and what do they want from an acquisition. Do they want the cash to be available for them? Do they want to give up everything and run away and start something new? Do they want to stay in the new program as long as possible? How much cash do they have to take off the table? How much equity do they have to give? How much is the equity worth afterwards to other people? How much do they want to refund the people that invested a severe amount of time into developing the new product that is currently bought from your company? All of this needs to be put up, and there are many more questions to be answered. But that's not the scope of today's video. It is more to think of what are potential strategic acquisition exits and investment partners and where to find them. I hope this video was helpful to you. Thank you for tuning in, and see you next time.